Hi. Continuing on with Chapter 11 and our look at corporations, we're going to start looking a little bit at some of the other things that can happen. And one of the first things is, and many companies and stockholders are interested in, is a cash dividend. Well, now to do a cash dividend, a company needs two things. They have to have cash and they have to have retained earnings. Some companies, or states rather, allow companies to issue a dividend if they have a deficit or a negative amount of retained earnings, but most states do not. They require that they have both cash and retained earnings. Like I said, some states allow what they call a liquidating dividend, but we're not going to go into that because it is not that common. So the other thing about cash dividends is they are not automatic. They're not like interest that accrue and we know what we're going to get. The board of directors of the corporation has to decide to pay a dividend before a dividend is then given to the stockholders. When we do dividends, there are 3 dates that are important. The first one is what they call the date of declaration. And the date of declaration is the day that the board of directors vote to pay a dividend. Okay? So it is at this day that the corporation becomes liable to pay that dividend to the stockholders. Technically, the stockholders at that time become creditors to the company, and they can sue the company for their dividends once they have been declared. The journal entry on the date of declaration is a debit to retained earnings and a credit to common stock dividend payable or common dividend payable. The second date that's of importance is the date of record. And the date of record doesn't require a journal entry, but it is used to decide who gets the dividends, because whoever owns the stock on the date of record is the one who will receive the dividend. So you could have held stock for years, and the date of record was July 19th, and in the morning of July 19th, you called your broker and said, sell that stuff. It's never paid me a dividend. And they didn't realize one had been declared on the date of declaration. So they sold it during the day on July the 19th. You don't owe it at the end of day on July the 19th. So whoever bought it from you would be the one who would be getting the dividend. And ultimately, we have the date of payment. And that's just when the checks go out. So we cancel out our common stock dividend payable. And remember, this is a liability. So we close out our liability and we simply issue the checks then to our stockholders. So looking at quick study 11-6 in the book, it says prepare the journal entries to record the following transactions for Emerson Company. So on July the 15th, remember July the 15th, this is the date of declaration. So on that date of declaration, we simply debit retained earnings and credit that liability, common dividend payable for our $165,000. Okay. On August the 16th, this again is they told us this time, this is the date of record for August the 15th for the dividend declared on the 16th. Remember here, there is no journal entry. We just decide who owns the stock at the end of the day. And ultimately on the 31st, we call this the date of payment. We pay the dividends with a debit to common dividend payable and a credit to cash for our $165,000. So this basically is what happens if a company only has common stock. You get whatever the board of directors votes when they declare a dividend to the company. Okay? And again, remember that with a cash dividend, basically the company needs cash and a positive balance in their retained earnings account. So sometimes that doesn't happen. And so what, instead of a cash dividend, a company declares a stock dividend. Okay? And a stock dividend, you receive shares of stock instead of cash, but you don't have to pay for the stock that they give you either. In this case, they need retained earnings, but they do not need cash. So some companies that have paid out most of their cash buying things, but they still have a lot of retained earnings, are still able to give something back to their stockholders in the way of additional stock. And lots of people like a stock dividend because, for one thing, you don't have to pay taxes on the stock dividend like you have to pay taxes on a cash dividend, number one. And number two, you hope that the company will start paying cash dividends later and you'll have more stock on which to get your dividends. Okay? So basically what a stock dividend does is it transfers equity from retained earnings to contributed capital. Your total stockholders' equity is not going to change. It's going to be the same amount before and after the stock dividend. And a stock dividend is just like a cash dividend in the fact that it has a date of declaration, a date of record, and instead of calling it a date of payment, they usually call it a date of distribution, but it's the same thing. There are two kinds of stock dividends. There is a small stock dividend, and that's for 25% or less. And when we have a small stock dividend, then it's recorded at the market value on the date of declaration. So we have to go to the market to find out what our stock is selling for that day. A large stock dividend, more than 25%, and it's recorded at either par or stated value. There's a difference for reasoning as to why a company would give a small or a large stock dividend. A small stock dividend is simply in lieu of a cash dividend to get more stock into the hands of the stockholder. Large stock dividends are usually when a company is very, very small and it wants to go public, and so to the very few stockholders they have, they give a very large stock dividend. Those people can then sell part of their stock on the open market on them and get money for it that comes to them instead of to the corporation, but they can still maintain control of their corporation. So what I thought we would do is we're going to look at quick study 11-7, but we're going to make a couple of changes in it. And so they're talking again about a small stock dividend because that's the most common type that we find. The stockholders' equity section of Gen Company balance sheet as of April 1st is as follows. So right here, they had common stock. It was $5 par value. They had 375,000 shares authorized. Remember, that's the maximum number of shares they can ever issue. Out of this 375, they have issued 200,000 shares, and they are outstanding. And we'll find out what more outstanding means later, but outstanding means that it's in the hands of stockholders, so it is outstanding. We can always get this number simply by multiplying our par value times our shares of stock. That's why this is $1 million. We also have paid in capital in excess of par from the common stock at $600,000. So when I added those two together, the common stock and the paid in capital in excess of par, I come out with the total contributed capital, and the total contributed capital is $1,600,000. They have $833,000 in retained earnings. So right now, before the stock dividend, their total stockholders' equity is $2,433,000. Afterwards, it will also be $2,433,000. So what I thought I might do, instead of just doing what they ask, and that is to go ahead and just redo the stockholders' equity, I thought I'd go ahead and make the journal entries for us anyway. So on the date of declaration, they said that they were going to give a small stock dividend, so it's 10%, and it's telling me that the market price, the stock's per share market value on April 2nd prior to the dividend was $20. And so what we're going to do then is this. We're going to make a journal entry on this day. And so we have to do a couple of things. One thing, we're going to take this 200,000 shares that are issued and outstanding, and I'm going to multiply that by 10% because it's a small stock dividend. And so what we are going to then distribute is 20,000 shares of stock in the stock dividend. Okay, so we know that that's what it's going to be. So what we have to do first is we have to take and multiply this $20,000 times our market price, and they said our market price was $20. So when I multiply that together, I hope, if my math is right, it's going to be $400,000. I'm going to take that same 20,000 shares, and I'm going to multiply it by my par value. And my par value is $5 a share. So when I do that, it's $100,000. And then I'm going to look for the premium. And the premium is the difference between the market price and the par value. So I'm going to multiply that same 20,000 shares in the stock dividend by that premium or excess over par, and that's $15. So 15 times, pardon me, 20,000 shares is $300,000. So on the date of declaration, I'm going to make this journal entry. And what I'm going to do is I'm going to debit retained earnings for the $400,000. Okay. I'm going to credit an account called Common Stock Dividend Distributable. And that common stock dividend distributable then, is going to be for the $100,000. And then I'm going to credit my regular paid in capital in excess of par value common stock, and that's this $300,000. So this is the date of declaration. Remember, the date of record. We always like this one, no entry. And ultimately, then, we're going to, so push that up a little bit so you can see it better. So on the date of declaration, after we've made these calculations, our journal entry is going to be a debit to retained earnings to reduce our retained earnings by $400,000. We have a new account called Common Stock Dividend Distributable. That's the one we use on the date of declaration at $100,000. That's our par times our shares in our small stock dividend, and a credit also to paid-in capital in excess of par. That's the difference between the par value and the market value that we have. And so ultimately then, instead of a date of payment, we usually call it, with a stock dividend, the date of distribution. This is when we're going to send out that stock to the stockholders. And so all we're going to do on this particular date, the date of declaration, all we're going to need to do is to debit common stock dividend distributable. Hope you don't mind me shortening it up a little bit. And that was the $100,000. And we're going to credit common stock for $100,000. So these two are the journal entries that we would make with our small stock dividend. And so I'm going to be lazy. I'm going to come up here and I'm going to make some changes. All right. The common stock, so we can compare. Our common stock is still $5 par value. We still have 375,000 shares authorized. But now, because we gave out 20,000 shares, we now have 220,000 shares issued and outstanding. And remember, we put an extra $100,000 into the common stock account. So this is now, instead of $1 million, it's $1,100,000. Are paid in capital in excess of par value. That was $600,000. Right here, we added another $300,000 to it. And so what we have now is, where are we? Oh, there's 6 plus 3. This is now $900,000. Pardon me. So our contributed capital is now, what have we got here? We've got to add it back up again. So it looks like $2 million. Our retained earnings, that was $833,000. We reduced that by $400,000. So this is now $433,000. So this was our stockholders' equity section of a balance sheet before, and this is ours after. And like I said, our total stockholders' equity is still the same $2,433,000 that we had before. So all our stock dividend did was it reduced our retained earnings and increased our contributed capital. And so this is what happens with a small stock dividend. If it had been a large stock dividend, then this entry here, instead of being done at market value, would have been done at our $5 par value, and this entry would have been the same. excuse me. And when we did this, then our retained earnings would have gone down, the common stock would have gone up, but our paid-in capital in excess of par would not have changed. So this is what happens when we have a stock dividend. Another thing that can happen to a corporation and to our stockholders then is we can do what they call a stock split. Well, why do we care about stock splits? Well, sometimes the market price, the price out there on the market, the stock keeps going up and up and up in value. And the higher that it is in value, the fewer the people can buy one share of stock. I don't know about you, but I could buy a $10 share of stock easier than I could buy a $1,000 share of stock. And so what they are going to do with a stock split is they distribute some additional shares of stock to our stockholders. And again, just like our stock dividend that we looked at a minute ago, they don't pay anything for it. And usually it's like a ratio. So an example is a 2-for-1 stock split, where you would get 2 shares of stock for every 1 share you already had. So if you had 50 shares of stock and we did a 2-for-1 stock split, you'd end up with 100 shares of stock. And you kind of want to do the same thing with the stock split that you did with the stock dividend, and that is now you have more shares of stock. You hope they keep paying dividends and you'll get more dividends as well. What happens, however, with the stock split is it has to reduce the par value or the stated value and the market value. So if before we had $10 par value common stock with a $30 market price, after the stock split, it would have again, I'm going to say a 2-for-1 stock split. Then the par value is now $5, and the market price would drop to $15. So the thing with a stock split, it all happens, again, they would have a date of declaration, date of record, date of distribution, but we don't make any journal entries. All we're going to do is change the looks of the stockholders' equity section of our balance sheet, where before it said it was $10 par, now it'll be $5 par, but the amount of money will be the same because it was a 2-for-1 stock split. Okay. We talked earlier about the other kind of stock, and that is preferred stock. I put PS there so I can abbreviate. Okay. Normally, preferred stock has a par value. Lots of times, preferred stock has a common $100 par value, and it also has a dividend rate, the percentage of dividends based on the par value that you would get as far as the dividend is concerned. So if we had like an 8% dividend, that means that every share of common stock would get annual dividends then of $8. Okay? Just like common stock, dividends have to be declared. They have to have a date of declaration, a date of record, and a date of payment. But we can also look at terms that go with common stock. Preferred stock. The most common one is cumulative. Preferred stock could be either cumulative or non-cumulative, but most of it is cumulative preferred stock. And what that means is that they don't miss out on a dividend if a company fails to pay it in a year. It turns into what they call dividends in arrears. So if we had a company that didn't pay dividends in 2018 or 2019, but paid them in 2020, then this company would have 2 years, if it was cumulative, there would be 2 years in arrears, dividends in arrears, and before the common stockholders could get anything, we would have to pay the preferred stockholders the dividend in arrears for 2018 and then 2019, and then we'd have to pay the current dividend of 2020 before the common stockholders could get a dividend in at all. And that's why it says we must pay preferred stockholders all dividends before the common stockholders get a dividend. And that's true whether it's cumulative or non-cumulative. If it's cumulative, we could have dividends in arrears if the corporation failed to declare dividends in a previous year. If it's non-cumulative, basically they lose all past dividends that have not been declared, that we would still have to pay the current dividend to the preferred stockholders before the common stockholders get anything. Okay, so why do people want or companies issue preferred stock? Well, it's a way of raising money or capital to operate the business without having to repay it like a loan or pay interest on it like a loan. And it's also non-voting stock, so they don't have any real control of the corporation like the common stockholders do. There's 2 other terms that they talk about, but it's very, very uncommon for a preferred stock to have it. One is most preferred stockholder, most preferred stock is non-participating. And what that means is, since it's non-participating, all they get is their annual dividend rate. If it happens to be participating, what that means is that after we have satisfied any dividends from the past that we owe to the preferred stockholders, and we give them their current dividend, and we pay a dividend equal to the common stockholders, that would be our 8%. Then if they want to give out more money, then if it is participating, that means the preferred stockholders could get something extra over what their 8% annual dividend is. If it's non-participating, they would not. Oh, pardon me. Sneeze. Thank you. Okay, so we're going to take a look at Quick Study 11-9, and we're talking now again about preferred stock. Okay, so preferred stock issuance and dividends. Prepare the journal entry to record Tomas Company's issuance of 5,000 shares. Excuse me, I'm going to hope I do this right. Hi. Leaving off, we had talked about, and we were participating and non-participating. I believe we were just starting with Quick Study 11-9. So preferred stock issuance and dividends. Prepare the journal entry to record Tomas Company's issuance of 5,000 shares of $1, and now I'm looking for my calculator. There it is. $100 par value, 7% cumulative preferred stock at $102 cash per share. So again, they're selling it at a premium. So we're going to make the same kind of entry that we made before for common stock. We're just going to debit cash, and that's going to be for our 5,000 shares at our $102 per share. So 5,000 times 102 is $510,000. We're going to credit preferred stock for our 5,000 shares at our $100 par value. So this is $500,000. And then we'll have paid in capital in excess of par value. This time we'll put a PS for preferred stock on the end of it. And we know that this is, just to make it balance, we know it's $10,000, or we could have taken the 5,000 shares at the $2 premium per share and come out with our $10,000. So we are in balance. It says assume the facts in our Part A, Part 1. If they declare, Tomas declares a year-end cash dividend, what is the amount of dividend to be paid to the preferred stockholders? And they're assuming no dividends in arrears. So again, we're going to look at, you can do it a couple of different ways, but $100 par value times 7% means that each share's dividend is $7 per year. We're going to multiply that by our 5,000 shares, and we'll come out with $35,000. Okay, so again, they just asked for this amount of $35,000, but again, preferred stock is just like a dividend, is just like a common dividend, and that is on the date of the date of declaration. We would debit retained earnings for our $35,000 and preferred dividend payable because this is when we become liable. The corporation is now liable to pay it. We'd have a date of record to determine who gets the dividend, but again, no entry. And we'd have a date of payment. And on the date of payment, we would just debit preferred dividend payable and credit cash for our $35,000. So each share of preferred stock that someone owed, they would get $7 per share on their dividends. Okay. So for dividends, we're going to go on and we're going to look at Quick Study 10, dividend allocation between the classes of shareholders. So it's telling me that the stockholders' equity of Ernst Company consists of, so we're going to write this out here so I don't have to keep looking it up. The preferred stock, there is 80,000 shares. $5 par value, 8% cumulative, and our common stock, they have 250,000 shares of $1 par value common stock. Notice that it does not have a dividend rate to it at all. It says both classes of stock have been outstanding since the company's inception. Ernst did not declare any dividends in the prior year, but now it declares and pays $110,000 cash dividend at the current year end. Determine the amount distributed to each class of stockholders for the 2-year-old company. So we know what we have here, and what the company is then willing to pay in dividends is $110,000. So we need to know how much of the 110 goes to the preferred stockholders and how much goes to common stockholders. So what we're going to do then, again, a couple of ways, but I'm going to take for the preferred stock, I'm going to take that $5 par value, and I'm going to multiply it by 8%. And when I multiply that out for 8% for a year, that means that each share of stock is going to get 40 cents. We're going to multiply that by the 80,000 shares, and that's going to equal my $32,000. So the annual dividend is $32,000. So what the preferred stockholders are going to get, because it is cumulative, so for last year, the preferred stockholders will get $32,000. For this year, they will also get $32,000. So the preferred stockholders are going to get $64,000, or each share of stock is going to get 80 cents, 40 for last year and 40 for this year. So the total dividend to be paid is our $110,000. The preferred stock is going to get $64,000. And when I do this, this is then going to leave $46,000 for the common stockholders. And so each one of the preferred stock will get, I'm going to put it out here, they're going to get 80 cents per share, because if we multiply 80 cents times 80,000 shares, we'll come to the $64,000. I'm going to take $46,000. They didn't expect us to do this, and divide it by the 250,000 shares of common stock. So $46,000 divided by 250,000 shares. Each one of the common stockholders is going to get 18.184 cents per share in dividends. And so this is what happens as far as our dividends are concerned. So in the next video, we're going to look at then treasury stock, and we're also going to look at a thing called earnings per share.